What's going on, guys? Welcome back to the channel. Today, I'm going to be talking about some of the differences between a Roth IRA and a traditional IRA. So stay tuned. And like always, to cover our bases here, this video is not financial advice, nor should it be construed as such. This video is strictly for educational purposes. And now with that out of the way, let's get into it. So in my last video, I talked about some of the account types you could open when starting your wealth building and investing journey. If you haven't seen that video yet, that's okay. Just make sure you go watch it before you continue with this video. It'll give you some context. Specifically, when I was talking about the IRA retirement section, I talked about two different account types, the traditional IRA and the Roth IRA. And I want to dive into those a little bit here today. Let's start with some of the similarities between the two. They are both designed to be a saving vehicle for your retirement, and they are both subject to the same contribution limits. As I mentioned in the last video, for the year of 2021, it's $6,000 if you're below the age of 50, and if you're above the age of 50, you have something called a catch-up contribution, which is an additional $1,000. This applies to them both, and they are both subject to something called the 10% early withdrawal penalty. What that means is if you take a non-qualified distribution from the account, it may be subject to a 10% penalty, because these accounts are designed to give tax benefits and incentives for investing to your retirement. In both of these accounts, in order to have what we call a qualified distribution, you must be above the age of 59 and a half, and the account must have been open for at least 5 years. But there are qualified exceptions. Some of these exceptions include medical expenses, health insurance, a first-time home purchase, something called 72T payments, which are a series of equal payments, certain higher education expenses, and in more recent times, certain things along the lines of COVID for a relief. I'm also going to be dropping the link to the IRS.gov website in the bio that will outline these in a little bit more detail if you do want to take a deeper dive into that. Some of the other similarities between the two is that there are income thresholds for both of these IRAs and the contributions you can make to them if you are already covered by an employer savings plan, such as a 401k. These income thresholds can affect the deduction you can take on some of the contributions of that $6,000 or $7,000 depending on the age, if your income is above a certain amount or between a certain amount, or it can affect your entire ability to contribute to a Roth if you make more money than a certain amount. This is also important to look into before opening up an IRA so you know exactly what you're able to contribute or deduct depending on which one of these two you open. I will also drop a link in the bio to the IRS.gov website that'll show you what these income thresholds are if you are indeed covered by an employer savings plan. Now let's get into some of the differences. With a traditional IRA, you are able to take a tax deduction in the current tax filing year and defer, which means push back, the taxes that you pay on any of your contributions until later in the future when you decide to take them out. Now, when could this be more beneficial for someone? This could be better for someone who is making a higher income here today and they don't think they're going to be able to maintain that high level of income going into the future. So they want to push the taxes out until they make less money so they get taxed less. This is a little bit more common among sales professionals or professional athletes. The traditional IRA also has something called an RMD, which stands for Required Minimum Distribution. What that means is when you reach the age of 72, you are required to pull out money on an annual basis and pay taxes on that amount. The way I always explain this is the IRS doesn't care how they get their tax money, they just care that they get their tax money. And they don't want you pushing the taxes all the way out until you can't pay it, for whatever reason that may be. Now, with a Roth IRA, you pay the taxes today and you let the earnings grow tax-free into the future until it becomes a qualified distribution. Now, a little bit of a difference with the Roth IRA is because you've already paid the tax on anything you put in, you have a little bit more flexibility to withdraw the money out of the account. So you can take out whatever you've put into the account at any point, penalty and tax-free. Now, the 10% penalty would come into play is on any gains in the account, since that's something that you have not paid the taxes on quite yet, if it is an unqualified distribution. Generally speaking, the Roth IRA could be better for someone who thinks their income is going to go up over time and they'd rather start paying taxes when they're in the lowest tax bracket they'll realistically ever be in for the rest of their lives. In contrast to the traditional IRA, Roth IRAs do not have any RMDs involved until they become inherited, which I'll get into in a different video. Now, I hope you guys found this useful. I hope this was easy to digest. Thanks for watching, and like always, let's get lit.